You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. The recent decline in mortgage rates has caused a miniature refinance boom, pushing some measures of refi activity to their highest in 3 years. While pandemic-era mortgage lock is keeping many homeowners attached to ultra-low rates, rates have fallen enough from the cyclical peak that housing market churn is finally starting to pick up. The rise in MBS prepayments is still to come, with significant implications for MBS investors in the months ahead. On today's episode, we talk with Walt Schmidt, manager of mortgage strategies with FHN Financial, about what's caused the recent fall in mortgage rates, the impacts on MBS prepayments, and whether another refinance boom could be on the way. Stay tuned. Coming up soon, our interview with Walt Schmidt, but first, a quick market update. The federal government shut down this week at midnight on Tuesday after congressional leaders failed to find agreement on a continuing resolution to keep funding the government. This shutdown does not come with the risk of a debt ceiling breach, so Treasury's debt service payments will not be affected. As a result, the shutdown's biggest market impact for the time being will be the delayed release of government statistics like the September jobs report and weekly jobless claims that were originally scheduled to be published this week. If the shutdown continues much longer, collection efforts for October data could be disrupted. Earlier this week, the August JOLTS and September ADP reported further labor market weakness, with ADP showing the second consecutive month of a fall in private sector payrolls. In lieu of any government data this week, the bond market gave outsized focus on the ADP number and rallied 5 to 7 basis points across the curve. Last week, the second revision to Q2 GDP, along with annual benchmark revisions from the BEA for prior years, rewrote the economic growth narrative for the first half of this year. The originally reported data suggested the economy had slowed through policy uncertainty, but the latest numbers suggest robust growth that should continue into the third quarter. The Fed policy implications are unclear for now. The Fed's dual mandate focuses on the labor market, not economic growth, and job growth has stalled. Accelerating GDP growth could be the precursor to future job growth, or it could stem from capital-intensive investment that won't necessarily come with rising labor demand. Treasuries stayed range-bound the last couple of weeks, selling off after the upward GDP revisions, but rallying after the weak ADP. There could be some aimless drift over the next couple of weeks if investors are left with only private sector data to gauge the economic outlook. Yields on 10s briefly touched below 4% a couple weeks ago, but have since been anchored close to 4.10%. Fed Governor Stephen Miron gave a speech at the Economic Club of New York that outlined the reasoning behind his ultra-low 2025 dot at the latest Fed meeting and why he thinks the neutral policy rate is much lower than many of his peers believe. He is clearly an outlier for now, but his speech could foreshadow the perspective of the next Fed chair when Chair Powell's term ends next May. That's all for the market update this time. Now our interview with Walt Schmidt. Our guest today is Walt Schmidt, manager of mortgage strategies with FHN Financial. Walt, welcome back to the podcast.
It's great to be back, Will. Thanks for having us again.
Our topic today is the recent fall in mortgage rates and what it means for the MBS market in the months ahead. So just to start things off, the average rate for a 30-year fixed-rate mortgage is about 6.35% today, according to Bankrate. This is a big step down from the cycle's peak above 8% at the end of 2023, but it's also almost 45 basis points lower than where it was only 2 months ago. Walt, what do you think explains the recent rapid decline in mortgage rates, especially compared with the relatively smaller declines in Treasury yields over that time?
Well, so market practitioners would say that mortgage-backed securities have performed very well relative to their underlying rates hedges or Treasury hedges. And so as the yield on the MBS goes lower, that should, and in this case has, translated to lower borrowing rates for the borrower. Sometimes it doesn't always work that way. The transmission mechanism breaks down. But in this case, certainly we've seen that follow through the rate that the borrower is being charged.
And so how has this decline, both the longer run of the last 2 years and the last few months, changed how financial institutions are approaching MBS for their portfolios? I know we all go back to the peak of inflation in the middle of 2022, where people were worried about how much further interest rates were going to go up. But now that the direction of travel really is lower, how is this changing how institutions are looking at MBS?
There's really more than one type of buyer of MBS, but you hit the nail on the head by mentioning banks because they're the largest, as a group, the largest owner of MBS securities. They own about 35% of the outstanding float of Fannie Mae, Freddie Mac, and Ginnie Mae mortgage-backed securities. And so they obviously have a longer horizon, a longer investment horizon than, say, a hedge fund or an asset manager would have. And certainly banks, yes, are now very concerned about prepayment risk, as are all MBS investors, because as rates fall, we have a cohort now of relatively newly issued over the last couple of years MBS with much higher coupons, much higher what we call gross WACs, or the coupon that the borrower is paying. And so once those rates go in the money for a refi, we expect refinancings for certain mortgage-backed securities to be very fast, particularly those with coupons of 6% or higher. So sixes, 6.5s, and sevens have been created at a pretty aggressive clip, really over the last couple of years until very recently. So those are very refinanceable, and banks are rightly concerned about that. In fact, a lot of banks that we talk to, even over the last couple of years, would not buy those current coupons because they were afraid of that prepayment risk. They would buy more of the middle coupons, call it anywhere from 4 to 5% coupons, because they were concerned about this prepayment risk that's in the market.
I want to revisit prepayment risk and how it ties into refinancing a little bit later. But for now, I think the concept of mortgage lock has characterized so much of the housing market this cycle. People got mortgages in 2020 or 2021 when rates were ultra low. And then once rates started to go up a lot, those homeowners really didn't want to give up those low borrowing rates. More than 5 years after those early pandemic shutdowns, give us a sense of how different people's effective rates are now, and how they compare to if they wanted to get a new mortgage today.
We have a chart in one of our decks that looks at that very thing on average in terms of big numbers. And obviously, everything is at the margin, or everything is important for the individual borrower. But on average, the borrowing rate that's available now, even after rates have dropped, as you mentioned earlier, is still more than 2 percentage points or 200 basis points higher than the average rate that's on the outstanding MBS in the conventional universe, in the Fannie and Freddie universe. And Ginnie is somewhat similar, although those rates are a little bit lower. So even after this drop in rates, we are still what we call have negative incentive, or out of the money by more than 200 basis points. And so that means that most borrowers still are not able to refinance or to move or to do anything that they want, or those types of things that they want with their home purchases or transactions, because they're still that far out of the money. But like I said before, it's hardly a homogenous thing. There are a very wide range of outstanding mortgage rates. As you mentioned, some people had two-handle mortgages from back in 2020 and 21. There's a lot of three-handle and four-handle mortgages, and now rates are only getting close to the low sixes. So again, a lot of borrowers still very far out of the money.
So with that recent fall in mortgage rates we talked about, there has been a mini boom in refinancing lately. The Mortgage Bankers Association index for refis reached its highest this month since early 2022, because as we said, if mortgage rates peaked at 8% in 2023, well, there are people who had that financial incentive to refinance. Do you think the refis will continue from here, or have the people with an incentive to refi already gone ahead and done it?
No, this is just the first step of that. In fact, as you mentioned, the refi index did, and it wasn't just that it's high now relative to the last 2 years. It popped higher just 2 weeks ago by 60%, almost 60%. So it kind of came out of nowhere to a certain extent. It's just the beginning. We haven't even seen that refi activity yet in the prepays, right? So we're recording this just before the end of the month in September. We'll get the September prepay report in early October, early next week, and that will be the first picture that we'll see of prepayments that are based on these lower rates that we've been talking about. And even that's just the beginning, because some of the rate locks that occurred over the month of September will not have already closed by the time the end of September comes around. So the increase in the refi index that we saw 2 weeks ago, that's just the beginning. We should see now faster prepayments, quite a bit faster prepayments for the current coupons that we talked about over the next 2 months at least. And that'll probably go into the future, unless, of course, rates go back higher from here.
Let's talk a little bit more about prepayment risk for MBS investors. You brought up that term a bunch. What does it mean? Why is it something that is relevant for people who invest in MBS? And what share of prepayments are from refinancing?
So there's two main risks. The first and obvious risk is if one purchases an MBS security or any other mortgage-related asset above par, above 100 cents on the dollar, and prepayments come in very fast, the actual yield profile, what we call the carry or the month-to-month amount that you earn, the coupon that you earn on that, goes down very quickly because you have to amortize that premium very fast, faster than you would expect. But there's another risk. Even if you were to buy those coupons near par, so you don't have to worry about the yield on that asset going lower, you have reinvestment risk, right? And so that's really what happened to a lot of investors in 20 and 21 when the pandemic lockdowns came in and the Fed cut rates and they started buying mortgage-backed securities. A lot of investors saw that the previous higher rates that they owned disappeared on them. Even if they own them at par, all of those MBS refinanced on them, and they had to reinvest now with more deposits. They had to reinvest at those lower rates. And so you have not only the potential yield erosion if you buy bonds at a premium, but you have reinvestment risk, which is, in my mind, even maybe a greater issue if rates fall and you have to reinvest in a lower rate environment.
So just to be clear, to put that prepayment risk into some numbers, if I was a lender who was getting an 8% return on that mortgage and now someone refinanced, well, I have all of their money back and my available rates to invest that or lend it out to new investors is now closer to 6 or 6.5%.
Exactly. And if you're talking about MBS securities where there's a certain percentage of that that goes to pay the guarantee fee, there's servicing fees and the like, the current coupon is much lower than that. It's closer to 5% now. It got to be, in the mid sixes at the very high point. For the better part of the last 2 years, we were kind of bouncing between 5.5 and 6 as the current coupon. Now the current coupon is closer to 5. From an MBS standpoint, those are the rates that we're talking about, and that's the reinvestment risk that comes into play.
You talked about how that refi index from MBA really popped in the last few weeks. And I think that's interesting because if you look at average mortgage rates, it's been a pretty gradual decline, with some ups and downs since the end of 2023. But it has not been anything that would signal that, okay, suddenly there's this threshold where now a group of people have that financial incentive to refinance. So do you think that there is a next threshold for a wave of refis? Is it even useful to think of thresholds, or from here on out, is it going to be much more gradual?
No, it's in fact, you're hitting on one thing that we point out very often. Alexis Villamis, who works with us in our group and does a great job tracking a lot of this prepayment data, we update something called our stack by WAC, where we look at the outstanding mortgages that are in the Fannie Freddie universe, particularly. We also look at Ginnie, but we kind of concentrate on Fannie and Freddie. It's larger. And there's certain breakpoints where there's a lot of outstanding issuance in certain, small buckets of 10 and 20 basis points. So there are certain breakpoints. And as we went below 640, there was a big breakpoint of quite a bit outstanding, more than 500 billion outstanding. Kind of hard to explain without the chart in front of somebody, but there are breakpoints like that. The other thing that I would point out is that there are seasonal factors involved. We tend to see faster prepayments in the spring and in the fall for various reasons. The spring tends to be very active for people to move, buy new homes and things like that. The fall also may be a little bit more active from a financial standpoint, where people aren't moving in the fall, but they've come back from summer vacation. Rates are a little bit lower. They get a bunch of calls from their lender, and people are paying a little bit more attention in September, October before you get to the holiday season. So seasonal factors also play a role in this. So the fact that it happened in mid-September is not a surprise.
Is it possible that mortgage rates have potentially plateaued? I mean, maybe this is the $20-30 trillion question, but I think everyone has come to the understanding that we're not going to go back to the ultra low rates of 2020 anytime soon, and probably not even the low rates of the decade before the pandemic. So if mortgage rates have plateaued, is it possible that prepayments have already reached their peak, or is your prediction that they will continue to speed up?
We haven't seen it yet in the prepay data. We still need to see the prepays based on the pop in the refi index that we saw. To your point, I really feel like, and I've talked to a number of people in the industry. By the industry, I'm talking lending industry, I'm talking the MBS industry. And a lot of people tend to think that something with a 5 handle is kind of like a natural good rate for mortgages. It's not so low that there's no return available for investors. And it's not so high, like an 8% handle, where you're just kind of slowing down the housing market to a point where it's not going to continue. So I do think we can get into the 5 handle. If we do, that'll open up probably more activity in the housing market. You'll probably see more transaction volume. There are people at the higher end of the housing market that might want to downsize and move at that point. There might be people at the lower end that can now afford to move up if we get into a 5 handle. So I agree with you. I don't think we're going to see 3 and 4 handles anytime soon, absent some kind of catastrophic crisis. But I do think we're potentially on the way to a 5 handle, and that would mean another 50 or 60 or so basis points lower in rates. And that would put another cohort of borrowers, as I'm looking at the graph right now, in the money for a refi. So again, this pop in the refi index is just kind of a harbinger of the faster prepayments that haven't hit the tape yet, because those get reported monthly. Over the next couple of months, I think investors, some might be surprised by how fast prepays are for the current coupons.
Now, in the Treasury market, we can see market implied expectations for Fed policy, looking at Fed funds futures, overnight index swaps, the cash to your Treasury. Within the MBS market, can we infer any signals about what the market is expecting from prepayment risk in the future? Is there any signal there about what MBS investors think will happen in the future?
Well, there are signals in the derivative market. So there's a fairly actively traded, although the market isn't deep from the standpoint of number of investors, but those that are involved are very involved. And there's a pretty active IO, or interest only, and also inverse IO market that trades. And so that can kind of give market participants an idea. Look, if the IO market is selling off very quickly, then those that are most levered to prepayments are making a bet that things are going to speed up. And that's actually happened here recently. That market used to be a little bit more transparent when Fannie and Freddie used to issue what were called trust IO and PO strips. They don't do that anymore. So it's kind of over the counter more so than it was before. So it's difficult for non-MBS participants to kind of see that. But that's a little bit of a canary in the coal mine for faster prepays. We have things like the refi index and different things like that they show something that's going to happen before the prepayments actually come. And, the other thing, too, is the Fed, as you know, doesn't directly affect mortgage rates. They do when they're buying MBS during a QE period, but they're not doing that now. They're basically affecting monetary policy with the policy rate and forward guidance, as you know. And so the fact that mortgage spreads or MBS spreads have tightened during the last couple of months means that the MBS market is very optimistic that the Fed's going to continue to cut rates. We said earlier the bank demand is very strong. 35% of the market is owned by banks. So if the Fed is cutting rates and the yield curve is steepening, it's a lot easier for banks to own MBS. They're probably not going to buy at the pace that they bought in 2021 because they don't have as many deposits and because they were recently burned after rates started backing up in 22. But there still is room for banks to add more. And so as the Fed cuts the policy rate, it doesn't directly affect mortgage rates, but it indirectly does because it potentially stokes demand among the largest investor type for the market.
You point to what I think is one of the biggest, if not biggest, stories for macroeconomists and the Treasury market right now, which is this divergence within the FOMC, looking at the current data and expectations for the next, 6 or so months. And that is,
Hmm.
one camp believes that the economy is in pretty good balance, that inflation is still stubbornly high, the lower job growth is this natural consequence of stricter immigration enforcement, and the Fed doesn't need to be all that urgent to cut rates. And then you have another camp that says, no, we are seeing cracks in the labor market. These inflation pops are one off from things like tariffs, and the economy really needs support right now. Within the MBS market, do you think that story is also what is most important over this next 6 months? Or is there a different narrative arc that you think will be the most important thing shaping mortgage backed securities over the next year or so?
I think one of the things you told me, we had a conversation a couple of weeks ago just on the floor, and you said something that was interesting, and that is a lot of times when the FOMC has some dissenters, it's usually in one direction. But now you've got kind of three camps, as you just described. You have the camp that maybe we might cut a couple more times, but we're going to go very slow. You've got another camp that wants to cut aggressively. And you got maybe the makings of a third camp that doesn't want to cut anymore at all. I don't think anyone wants to raise rates at this point, but certainly those three views are out there. And so, yes, that does drive the MBS market. If the camp that doesn't want to cut anymore at all starts to hold sway for whatever reason, which I think is unlikely given the sunset of Chair Powell's term and who the president might put in there. But if that were to happen, that would be a negative for MBS demand because banks would not then be as aggressive. Even asset managers would understand that, the Fed's not cutting. There's less demand out there for MBS because they're just harder to finance. They're harder for dealers to finance, harder for banks to finance if the yield curve remains fairly flat. It's steepened a lot, but it's still fairly flat from a historical standpoint. So for the MBS market to continue to perform relative to treasuries, yes, it is under the assumption that the Fed is going to cut at least as much as the futures market says that they will.
To wrap things up, we had you on the podcast back in March discussing the potential privatization of Fannie Mae and Freddie Mac. 6 months
Mhm.
later, is there any update there? Where do you see things going from here?
The current administration is very practical in how they try to get things across. I thought it was very interesting that FHFA Director Pulte went on TV, I believe it was last week, if I remember correctly, and held up a chart, printed out chart of mortgage rates and said, Trump administration, and look how far rates have fallen. So, anything that they do, if it sort of reduces the likelihood that rates are going to fall further, they probably won't do it. We kind of, and others in the industry are in the camp that they wanted to potentially do an IPO-like transaction sometime this year. It seems very unlikely now as we get into early October almost that that's going to happen, but that's still part of the plan. And it remains to be seen how they want to try to handle that, right? There's several different versions of this that are possible. It could be, you stay in conservatorship and sell some equity to the marketplace. You take them out of conservatorship. The industry, and by the industry, I mean both the buy side and the sell side of the MBS market, has been very clear that mortgages have historically not been a credit product. So if you're going to do something with the GSEs to take them out of conservatorship, there needs to be some kind of backstop guarantee to the MBS. I mean, we have an informal backstop now through the preferred stock purchase agreements, but a more formal backstop would probably be the best choice if you're going to try to do an IPO of some sort with the two GSEs. But then there's also the issue of raising capital. One of the things that we talked about in the last podcast was the previous Trump administration. Their main focus was to try to get the GSEs to raise capital. That's continued even through the Biden administration. It continued, but a lot more needs to be done before you can kind of fully, I think, sell them off to the marketplace. So that's a 26 issue at this point. There's really nothing particularly new, but I would just remind everyone that this particular administration likes to see, certain results, and lower mortgage rates, whatever the outcome is one of the things that they're trying to achieve.
Walt Schmidt, thanks for coming on the podcast.
You bet. Well, thank you.
That was Walt Schmidt, Manager of Mortgage Strategies with FHN Financial. Two things stick out from that interview with Walt that I think are really important for MBS investors in the months ahead. The first is that any rise in prepayments from the recent refinance boom have yet to come. And the second is that there are distinct thresholds where lower mortgage rates become the catalyst for an increase in refinancing, rather than becoming a gradually attractive financial decision for borrowers. Government data releases will be delayed for the foreseeable future until the federal government reopens. In the past, agencies have published any delayed data gradually after government funding resumes, rather than all at once. The data originally scheduled to be published over the next 2 weeks include the CPI, PPI, retail sales, industrial production, and Treasury budget balance for September, as well as weekly jobless claims. The releases that will be unaffected over the next 2 weeks include the University of Michigan survey, the minutes from the Fed September meeting, August data on consumer credit, and a few regional Fed surveys. There are more than a dozen public appearances from Fed officials over the next 2 weeks, though it may be tough to say anything new during this period of relative data silence. The Fed's pre-meeting communications blackout begins at the end of October 17th, so policymakers may head into their October meeting without having seen or publicly commented on the most important September data. For now, we expect the Fed can follow through with a rate cut at this month's meeting with incomplete data, but a December decision would be more complicated. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.